So you want to become a funded forex trader in 2024. In this video, I'm going to be showing you guys exactly how you can do that and also secure consistent withdrawals. I'm going to be going through everything from trading plan, risk management, and also how to scale your funding once you have secured it, as well as how you can manage multiple different funded accounts in a portfolio. So if any of that sounds interesting to you, make sure to stick around until the end of the video. Make sure to like and subscribe for more content like this, and let's get straight into the video. Alright guys, so as I mentioned, in this video we're going to be going through everything you need to know about how to get prop firm accounts and also how to make consistent withdrawals from them, as well as how to scale your capital once you have secured your initial funding. So a quick list of what we're going to be going through in this video in order. First of all, we're going to be going through how you can build a trading strategy with an actual edge in order to pass the challenges. We're then going to go through risk management, when to scale your funding. For example, if you've secured your initial 100K in funding, when do you then scale that to 200 without going too quick and putting yourself at a statistical disadvantage by making your self have a negative expected profit. And we're also going to be going through how to trade multiple different funded accounts and also a few different approaches for how you can do this, not just using a trade copier, but also different approaches to sort of combine all of the different accounts and also trade them separately. So first of all, developing a statistical edge. So first of all, what I want to say is that before you even decide to take a funded challenge, you should already have a well back-tested trading plan, a proven statistical edge, and a full trading plan which you guys can follow. You know the ins and outs of through your back testing, through your forward testing, and ideally you would have proven the results of this back tested system over at least 6 months of live data. I have lots of videos explaining how you can develop a trading plan, and I have also multiple different videos explaining the exact trading plan that I use along with the strategy itself. If you guys are interested in that, make sure to watch this video first, and then you can go and check out some of my other videos. But before we continue, I just want to take you through a quick overview of what this would look like. So if we get up the trading plan, this is the current trading plan that I'm using. It's a very simple trading plan, but the idea of this is just to give you a brief outline of the strategy that I use, which I've obviously back tested and also collected a lot of data on. So I know that over a sample size, it has a statistical edge, and therefore when I'm taking prop firm challenges, I know that I have an edge rather than just gambling and placing random trades. So the first step of my strategy is to identify overall market structure and direction. So in order to show you this more clearly, I'm going to go through a quick example on gold. So at this point in time, I was focusing on this price action on gold on the 4 hour for my higher time frame direction. And what I could see was that price had swept these highs, failing to close higher. And then we had also broken down and created a new low. So just here, which I mark on with a B just for break of structure. So at the time, what I was looking to do was sell with this prevailing trend, the trend being bearish. And what I was looking for price to do, which is step 2, is then identify a point of interest. And for this, I was using the type 2, which was liquidity taken out on the higher time frame, followed by a confirmation. My other type of point of interest is just an imbalanced area of supply or demand. And we also have to see some liquidity taken out as price comes into that zone. In this case, what I identified was this wick just here. The reason why I liked this area of liquidity was because lots of people were probably looking at this supply. SMC traders and just traders in general would be looking for price to retrace into this supply, give a rejection, and then continue to the downside. However, because we had this long wick above, which was created by CPI news for that month, I was anticipating price to sweep this level, and I was simply waiting to see how price would react once that area was swept. So far what we've done is identify a higher time frame structure. In this case, it was on the 4 hour. We then have waited for price to retrace and sweep an area of higher time frame liquidity, which brings us to step 3, which is to enter via a lower time frame entry confirmation. And for myself, not to overcomplicate things, this is simply a break of structure with imbalance. So if we jump down to the 15-minute time frame, and first of all, let's wait for that liquidity to be swept. There we go. So once that area of liquidity was swept, we go down to the 15-minute. We mark on the most recent structure, which at this point in time was this low just here. Since we had a push up breaking this structure, we then had a retracement followed by another push up, creating a higher high. But with this one, price immediately breaks down after sweeping the liquidity to the left and broke the 15-minute low, forming a lower low. And what I also saw at the time was that we had this area of imbalanced supply, which was a high probability area for myself since it was imbalanced. We had liquidity below, and it had also swept liquidity to the left. So for this trade, we then just set a limit at the supply, stops just above, and we can target the next area of liquidity, which was this low. So let's see how that played out. So there we go. That would have been 5% towards the prop firm challenge. So you would only need another 3% to pass the first stage. So yeah, so that is basically all I wanted to say on the trading edge itself. And like I said, that was just a brief overview of the trading strategy. Obviously, there are a lot more nuances and smaller details which I have gone into in previous videos, which you guys can check out after this one. So we've now designed a full trading plan, which we have back tested. I would say at least have it back tested over the last 3 years to ensure that you have a large enough sample size to see what is the long-term performance of the trading strategy actually like. So now that we've done this, what we want to do is, before we even think about going and taking a prop firm challenge, we want to be making sure that we can perform this and execute this edge as flawlessly as possible in the live market, and make sure that we can actually produce a profit in the live market rather than just in previous data in our back testing. So what I would recommend for this depends on your current situation really, but if you guys can afford it, $500 to $1,000, add that to a live account with a regulated broker such as IC Markets, Vantage, Admiral, brokers like this, and connect it to my FX book. So this is a key step, and you guys want to be making sure that you have it connected to my FX book or any software that tracks your statistics. So if you connect your account to my FX book, this is going to, every time you take a trade, it's going to record obviously the profit you made, but also things like the percentage, the average trade duration, the profit per time of day. So if you want to see which times of day you're most profitable, obviously also which days you are profitable, so Monday to Friday. Myself personally, I found that my strategy is not profitable on Mondays, so that led me to exclude Mondays from my trading. So you can basically get lots of interesting statistics like this from connecting your account to a software such as my FX book. But the real key metric that we want to be focusing on with this is your monthly percentage returns. So even though you are only trading a small live account at this point, the purpose of this account is not to flip the account and make lots of profit on. At first, this is simply for practicing executing your edge in a live market when you have real money at risk and obviously emotions come into play. And what I would recommend is collecting at least 6 months worth of data and seeing if your strategy can average at least 1% per month. That does not sound like a lot, particularly because of all the embellished results you see on social media, such as Instagram, where all the fake gurus are posting 100% account flips and whatever they do nowadays. So what you've got to realize is that in trading, if you look at the best institutions, best hedge funds, their traders are returning on average, maximum 3% per month consistently. And if you can do even 1% or 2% per month, you are beating the S&P 500, which is the benchmark index for any investment, and therefore you are doing very well. So all you want to be doing is aiming for those slow 1 to 3% returns monthly. If you can do more on some months, that is great. But for the most part, that is what we're aiming for. And as soon as we have ascertained that our strategy can produce those sort of results by connecting it to my FX book over at least a 6-month period, as I've mentioned here, then we can go about buying our first prop firm challenge, because we know that our strategy works and that we have an edge, and that we are not just simply gambling and entering random trades, which is going to cause us to blow the prop firm account anyway. And that next step brings us over to risk management on the actual prop firm accounts. And I see this is where a lot of people go wrong. So what a lot of people do is, with the challenges, they will come into the challenge with the expectancy that they are going to pass the whole challenge in one trade. So they'll go for big risk to rewards, such as a 1 to 8, or they may even risk, say, 3 or 4% on a single trade, hoping to only make a 1 to 2, which would obviously pass the challenge if you're risking 4%. However, this is not a sustainable approach, simply because even if you are a great trader and you have a proven statistical edge, you will hit a losing streak at some point, and the probability that you will at least lose 2 trades in a row, is a significant amount. I would say within 100 trades, the probability that you will hit at least 2 losses in a row is close to 1, so is certain. And because of this, we want to make sure that our risk management is in check. And what I've recommended here is, on the challenge phases, if you are new to prop firm trading and you don't have any funding at the moment, risk 1% on the challenge and verification stages. What you've also got to realize now is that most prop firms, if not all of them, are offering 0 time limit. So in total, between the challenge and verification, you're going to have to make 8 plus 5%, so 13% in most cases. So 13%, that is, a decent yearly return for most people, considering the benchmark of 8%, which I mentioned earlier, that most hedge funds are aiming for. Considering this, you can expect the challenge and verification to take, 6 months to a year, which is completely fine because, as I said, they are 0 time limit and this is not a race. And alongside that, you can also be practicing your execution on your personal account. So that time, even if, let's say, the worst thing, you blow the account, you've still gained that valuable experience regardless. So what we're going to also be doing is only taking high quality setups. And I've also recommended a good frequency for this as well. So personally, I would only be looking to take no more than 2 trades per week to ensure that the trades are only the highest quality, perfectly aligning with your plan with all of your confluences. I also find that if you start to take more than 2 trades per week, unless you are a scalper, obviously, if you're taking more than this per week, then the trade quality just goes down and obviously your win rate suffers, and that's going to lead to a negative spiral as well. Due to your psychology, you're not going to be able to handle that many losses in a row, particularly on your funded account. So yeah, in order to both give yourself a psychological edge and statistical edge, make sure you're only taking high quality setups that perfectly align with your plan, no more than 2 per week on prop firm accounts. Okay, so after that, what do we do once we have passed? So this is where things get a little bit interesting, because what most prop firms actually allow you to do is most prop firms offer a refund once you have your first withdrawal. So what we want to be doing is placing a 0.01 lot, wait for the trade to go, $1 or $2 into profit. And as soon as it does that, wait for your withdrawal date, which is usually around 2 weeks on most prop firms. And once we have waited for the withdrawal date, we can also withdraw the initial amount that we used to buy the challenge. So for a 100K account, say we used $500 to purchase it, we then get that $500 back after passing the challenge. So once you have this $500 back, there is zero downside risk on your part, if you're excluding the opportunity cost, obviously, of the time you invested in the challenge. But if you're looking at this from a monetary basis, then there's literally zero downside risk once you have secured that refund. Worst case scenario, you blow the prop firm account. The money is not yours. It doesn't matter. It's a demo account. So you've just lost the opportunity to make money, but you haven't actually lost any money, considering we've secured the withdrawal, if that makes sense. And after this, like I've said here, the account is risk-free. And what we want to be doing after this is in order to basically secure longevity and make sure that we're not blowing the account very quickly, is risking 0.5% on the live account. And I've also written down here a profit rule, which is that once the account is in profit, after hitting a take profit, wait and withdraw the profit. So we're not aiming for massive withdrawals of 10, 20%. We're simply looking to make 2 or 3%, secure the profit, and then go again. So for example, if you have 2 losses at the start of your trading period, that brings you to minus 2% on the account. If you then hit 1 take profit for 3%, assuming you're using a 1 to 3 risk to reward, you then have 1% in profit. So we can simply wait for the withdrawal date, secure that profit, and then go again. Obviously, this would also apply the other way, where, for example, if the first trade is a take profit for 3%, we then wait and secure that 3%. We don't want to be risking this money. We simply just want to be waiting and withdrawing it from the account, and then going again in order to make as many consistent withdrawals as possible. So heading over to the next section is, when do we decide to scale up and increase our funding? So what I've seen a lot of the best prop firm traders doing at the moment is using the analogy that you should treat prop firm accounts the same way that you would use risk to reward in your trading. So in your trading, imagine you're taking a trade. You're risking 1% of your account balance to make 3%. So you have a 1 to 3 risk to reward. We want to be doing the same thing with prop firms, but our risk is the amount we pay for the challenge, and then our potential reward is the amount of payouts we can get on that challenge. So thinking about it this way, personally, I would recommend a minimum risk to reward of 1 to 4 with prop firms. So let's say we're risking $500 on a 100K account. That means that in order to secure that 1 to 4 risk to reward, we need to make at least 2,000 on the live account and then withdraw. And at this point, we can scale up from 100 to 200. And the reason why we've put this rule into place is simply because, so imagine we've got our first 100K account. We then decide to buy, we have our first funded account. We then have our $2,000 withdrawal. That means that we can fail the next 4 funded challenges, and at worst, we are at break even. So that just basically helps your psychology a lot, because you aren't attached to the outcome of a particular challenge. And it also means that, worst case scenario, you're back at break even and you haven't actually lost any money. This is simply the same logic that we are applying to the live markets when we're trading with our risk to reward tool on TradingView. So to summarize all of that, the scaling rule is only buy another challenge once you withdraw 4 times the challenge fee or more. And to make sure that we have a positive expected profit as well, we want to be making sure that we're buying the same size challenges. So let's say, for example, our first account is a 10K, and then we withdraw say $400 for the 1 to 4 risk to reward. We don't then want to purchase a 100K account with that $400 withdrawal, because then if we lose the 100K account, then we are negative overall. So what we want to be doing, let's say you start with a 100K account, you then want to purchase another 100K account, then another one, then another one. We don't want to be going from 100, then buying a 200 or a 400. If that makes sense, you want to be making sure that the size of your account purchases is kept consistent throughout time in order to give yourself the best edge possible. And like I said here, only go for another challenge once you have withdrawn 4 times the challenge fee. And the last section that I wanted to go through is what happens once you have multiple different funded accounts. And I've basically divided this into 2 different approaches depending on your risk tolerance, as which will obviously depend on your personality and will vary depending on your character traits and things like that. And it will also depend on how much money you currently have and how much you can afford to lose. So for most people, I'd recommend this initial approach, which is the conservative approach, which is, first of all, always get similar account sizes like I just mentioned. So if we initially have 100K, when we are ready to scale, we're getting another 100K. We're not buying a 200K or a 400K. We're buying the same account size. And the reason I've given for this is basically because if you, let's say like I gave in the preceding slide as an example, if you go for a 100K initially, you secure your $2,000 withdrawal, and then you decide to purchase a huge account of 400K, which would cost you $2,000. If you lose this account, which, there's definitely a positive probability of that happening, you're back to break even. Whereas if you would purchase another 100K account, you would have made $2,000 minus the $500 for the second account. So you'd still be up $1,500 even if you lost the second account. So it doesn't really matter, which is why I've said that if you purchase different account sizes, you will skew the expected profit against yourself. So I've given also the analogy of, so let's say we're trading in the live market, we're risking 1%, but then we hit a losing streak. Scaling up to 200K after you initially have this 100K would be the equivalent of doubling your risk during doubling your risk during a winning streak or cutting risk in a losing streak. And while this may sound like a good idea, if you do the maths behind it, what you find out is that any strategy which doubles the risk during a winning streak or cuts the risk in a losing streak is expected to have a negative profit, i.e. a loss in the long run. So you definitely don't want to be doing this because you're obviously basically destroying your edge that you had in the market. You want to be keeping the risk the same by purchasing the same account sizes. So let's say we have less than 400K in funding. So anywhere between 0 to 400K in funding, this is the approach you should use. Trade each 100K account separately using 0.5% risk, using the same profit rule as before, which is obviously to withdraw once the first trade hits the take profit and the account goes into profit. If you hit a losing streak, keep trading that account that you've had the losing streak on until you blow it or go into profit. So if we blow this account, it's completely fine because we have the other 100K accounts. Say we have 400K in funding, for example, we will be trading one 100K account until we either blow the account or we make a profit. So if we blow this account, we then still have the other 300K in funding anyway, and we can simply move on to the next account. What this basically means is that in order to blow all of your funding, you would have to lose 40 consecutive trades. Sorry, 80 consecutive trades using 0.5% risk, which, if you're losing 80 consecutive trades, then you probably don't have an edge anyway, and you should probably reevaluate the strategy you're using. However, if that account goes into profit, we can then set that account aside and then get to work on a separate 100K account, again, risking 0.5%. And once the withdrawal date hits, we then withdraw the profit from all of the 100Ks that are in profit and then basically reset and go again. You could obviously alter this as well to do 1% risk on each 100K account. So if you have 400K in funding, that means you still need to lose 40 trades in a row before you blow all of the accounts, which, there's a very low chance of that happening if you have an edge. And so now this is a separate scenario for those of you that have 400 to 800K in funding. What we want to do is the same as this second bullet point, but instead of trading 100K accounts separately, we're going to combine the 100K accounts into 200K separate portfolios. So that means if we have 800K in funding, we want to, so if we have 800K in funding, that means we have 8 100K accounts. And then we simply want to combine these 8 100K accounts into 4 200K accounts and trade each 200K account separately using either 0.5 or 1% risk on each of the separate accounts. So not too different from this, except we're combining it into 200K accounts. Once we reach 800K or more in funding, we want to do the same thing, but combine the accounts into separate portfolios of 400K, again, using 0.5 or 1% risk on the accounts. So that is basically the conservative approach. But if we want to be a little bit more aggressive, maybe secure some bigger withdrawals and then use that to build up other investments, other businesses, or our own personal trading accounts, we can combine all of the prop firm accounts into a trade copier and use a 0.5% risk on the entire portfolio. So if we have 800K in funding, we're simply adding all of that 800K into a trade copier and then risking $4,000 on each trade. However, what we want to be doing, even if we're using this aggressive approach, is leave one of the 100K accounts untouched. So that means if we blow all of the other accounts, so all of the 800K, we still have this 100K account from which we can make a withdrawal and use to purchase other funded accounts and begin to stack up the funding once again after having lost it. So yeah, obviously as well, you could replace this with a 1% risk, but let's say you have 800K in a trade copier. I wouldn't advise doing 1% risk because it will only take 10 losses before all of your funding is gone. If you're using 0.5% risk, then you would have to lose 20 trades in a row in order to blow the funded accounts. But like I said, for the average person with the average risk tolerance, I would recommend this approach, because simply with this approach, the aggressive approach, if you're risking all of your funding accounts, let's say you go into 5% drawdown, how is that going to affect you psychologically? You're going to be entering bad positions. You're going to be forcing trades. You're just going to be not in the right state of mind to trade rationally and according to your edge, which would probably lead to you blowing the account when you go on tilt. So I would recommend this approach for the average trader, unless, the 800K in funding doesn't really matter to you and you can afford to just blow it anyway. So yeah, I hope you guys find this video useful. If you have any more questions about how I would manage a portfolio of prop firm accounts and how I would go about managing any of the accounts or the strategy itself that we're using, the risk management, whatever it may be, make sure to leave those in the comment section below, and I will catch you guys in next week's video.